Welcome to Common Sense Investing. My name is Cameron. Recently, I've been publishing a lot of videos on educating people on how to invest in microcap stocks, how to invest in penny stocks, not day trading, momentum swing trades or anything like that, but picking good companies with good financial fundamentals that you could potentially hold for a longer term and make some money in. And I typically compare this style of investing to Texas Hold'em poker. And the reason is everything, all the information you get gives you odds of winning. And if you put yourself in a position to win, more often than not, you're going to be successful in this space. I've been talking a lot about this, using data from Ryan Telford, where I'm not looking for a specific measure in revenue, earnings, cash, ROIC, or valuation, or anything else, where I'm not saying I need 25% in this or I need 15% in this. I've been looking at data that's showing that as long as these metrics are trending up, then that's something I'm interested in. Today, I'm going to look at return on invested capital and whether this is important to finding that next 10x penny stock and making a shit pile of money. Return on invested capital measures the return a company is making from investing its capital. It ultimately measures capital allocation efficiency and might signal competitive advantages. Now, don't forget, I'm not a financial advisor. I'm definitely not your financial advisor. I'm just one average retail investor just like you, and this is not how to invest in stocks. This is simply how I invest in stocks. Now, again, this is from Ryan Telford. I will link to him down below in the pinned comment. And he's talking about why price to earnings ratios can be difficult to compare. Below, he gives 6 different hypothetical stocks with varying growth rates, return on invested capital, cost of capital. One thing they all have in common is a fair value PDE of 20. So all these stocks have a fair value PDE of 20. The same valuation, basically. And what Ryan is pointing out with the data is that you can get a high growth stock with a low return on invested capital, and you're still going to get the same valuation as you would with a low growth stock and a high return on invested capital. So we don't really want that. If we're looking to invest in a stock, one of the best ways to make money, especially in the short term, is to get a stock where the valuation is trending up. Yes, over the long term, over 10 years, earnings and revenue growth will ultimately determine whether a stock is a 10x stock or not. But in the short term, it's been proven over 2 years that valuation improvement can make their shareholders a lot of money. So how do we get those higher PDE ratios? How can we increase the valuation or find stocks that are increasing valuation? Try to get into those and make more money. And what Ryan is saying the data is pointing to is a high growth stock with high return on invested capital. By charting different growth rates with 8% all the way at the top here and 0% at the bottom, when you have low return on invested capital numbers, it doesn't really matter what the growth rate is. The valuation, the fair PDE ratio, isn't very good, right? Sitting at around 10 with the low return on invested capital. Once you get this higher return on invested capital, all of a sudden you see it going up. But it doesn't get noticeable until about this 7% earnings growth with almost a 20% return on invested capital. And then, of course, seems to go up exponentially from there. So again, high growth, high return on invested capital is the stocks that we're looking for, because that's the one, this one stock here with 8% growth and 20% return on invested capital, all of a sudden has a fair PDE ratio of 40, so you get that valuation money. I ran this through a screener as best as I could, and look, there's huge limitations here. Canadian stocks with a price under $10, a market cap in the microcap space, really no dividend because I don't want dividend stocks. A lot of the sectors I've talked about in previous videos that are more likely to succeed to become a 10x stock, revenue growth of 15% or higher. And then finally, I have no screener personally for increasing return on invested capital numbers. So all I was looking for, all I'm screening for is stocks, is companies that have a return on invested capital of greater than 0%. When I ran that screen, I was actually pretty amazed. And then I sorted it by the higher return on invested capital numbers. And what you get are some significantly improved stocks this year. NTG Clarity Networks is up like 400% this year, right? California Nanotechnologies, that's another one up. My number 1 and my number 2 stocks for 2024 are right here on this list with a simple return on invested capital screener. Now, of course, a lot of this is hindsight. A lot of these companies, a lot of these stocks have already gone up. Is there further to go? Potentially, but I think the real main driver here is finding these stocks as they're improving these numbers. Back to this slide, right? Return on invested capital trending up as their growth trends up. One of the things that I discuss all the time on this channel is that growth stocks need growth, right? The cheaper and easier that a company can get growth, usually the better the stock. So it's no surprise one of the ways to achieve this is to be a successful investor of capital. So let's put this to the test again with 3 companies that I cover on this channel, right? Kraken Robotics right here. We get a consistent trend, fairly extreme though. This is a high growth and improving return on invested capital company. You can see they go from negative 58% return on invested capital all the way up to positive 13%. Enterprise Group, consistent trend, much less extreme than Kraken Robotics. This is a high growth, improving return on invested capital company, going from negative 6% to positive 13%, the same as Kraken Robotics. And then finally, Well Health Technologies, and maybe we can explain a little bit of their struggles with share price. They had a consistent trend in return on invested capital until they hit a wall right around here somewhere, right? Where they are a high growth company, but they have a low return on invested capital. That's what Ryan Telford is warning us about, just an average P/E, where Well Health Technologies went from negative 13% return on invested capital. They grew all the way to about 2% here, and then they're just stuck for a long time between 2 and 3% as their share price has been stuck. Easy to understand through Kraken Robotics. You could also see the trade-off between free cash flow and return on invested capital. So you see this high free cash flow here with Kraken Robotics back in 2020. All of a sudden in 2023, they have a negative free cash flow. That's the numbers right here. A lot of people, a lot of investors would panic on this number. All of a sudden they're losing cash. But you could see they obviously reinvested that cash into the business, which has now created higher return on invested capital numbers, and their share price has gone through the roof, or 4x, right? ADF Group, the same obvious use of cash, right? Free cash flow down in 2022, 2023 when they reinvested in robotics. Look what happens in 2024. Share price goes to the moon from like $1.50 to $20, right? It's the use of cash that is driving share price up, the successful use of cash. And while we could talk about return on invested capital trending up, and we may be looking for these long-term trending numbers, it's not always that easy. You could see a company, a stock like NTG Clarity Networks, really negative return on invested capital numbers for a while, 4 or 5 quarters, really good return on invested capital numbers for 4 or 5 quarters. Then it gets kind of average. So trends in microcap stocks don't have to be these great 5 or 10 year trends. It could be a simple year, 1 year where a company is reinvesting cash into the company, the next year where they're seeing this cash turn into better earnings. This is an easy trend to look for. At the end of the day, there's no crystal ball for microcap stocks, but I think the more information we have, the better information we have, the better decisions we can make, the more opportunity to look at a stock, look at a company, look at those first 2 cards that we have in our hand for Texas Hold'em poker, make a decision based on the odds, put ourselves in the best position to succeed more often. If return on invested capital and the trend up on return on invested capital is just one more tool in our toolbox of investing, I think it's a fantastic thing to use, fantastic thing to look at, and I'm going to keep incorporating it throughout the year in some of my stocks and see what happens. Thanks for your time. I really appreciate it. You've been watching Common Sense Investing. Let's go find a great penny stock.